Welcome to the Allan Small Financial Show. As always, I'd like to thank all of you for taking some time out of your busy day to share it with us. As you all know, we have these shows every couple of weeks. And on this show, we like to answer all the questions that you may have regarding what's going on in the investment world, what's going on in the stock market, the bond market, what is perhaps going on with your individual portfolios. We've seen a bit of a shift over the last month or so, maybe even just 2-3 weeks, not even a full month ago, that we saw the markets doing quite well. And all of a sudden, things have started to change once again. Is this primarily due just to seasonal factors, or are there other things percolating under the surface, which is causing individual investors to be a little bit concerned, a little bit nervous that they perhaps would be selling their investments at this time? So today we have a number of topics that I think are important that will shed some light as to what's going on currently. And here they are today. Market shift in August. Why are markets changing? Why has the tone turned negative in the month of August? Has anything changed really? We'll talk about that. This week, which is our segment where I talk about what I believe is important for individual investors to consider over the next couple of weeks. And we usually have three main ideas. China's economy is really struggling. Why is it struggling? What's behind their struggles, and can they pull it together? Do we anticipate that things will get better? And until things get better, what are the ramifications for the rest of the world, for global growth, global trade? U.S. banks facing scrutiny. What about Canadian banks? We've heard that a number of rating agencies are taking down their expectations for U.S. banks. Why are they doing that? Why is Fitch, the most recent ratings agency, taking down their expectations? And should we be concerned about Canadian banks? Are they having the same issues? Where should you be investing your money today? If you had some money that you needed to invest, you came into some money that, let's say, just fell into your lap, where would you be investing that money today? What are your options? U.S. retail earnings. A number of big U.S. retail companies reported earnings last week. A number of them are reporting earnings this week. What are they saying? And what message are they giving us with respect to how the U.S. economy is faring? And lastly, as always, your questions. I always like to get to a couple of questions every show at the very least. If I don't get to your questions at the end of this show, then hopefully we can address those questions at the next show. So without further ado, let's move on with the show. So we've seen a pretty dramatic market shift when we entered or changed the calendar from July to August. What has changed to cause this shift in sentiment? Why are investors all of a sudden getting nervous and are selling into this market versus buying the buying that they've been doing for the first 7 months of the year? What has changed? I guess the quick answer is nothing. Nothing has changed. We actually just went through an earnings season where corporations report their latest quarterly earnings, and more than 80% of U.S. companies that reported earnings recently beat expectations. Things looked fantastic. Stock market was trading at a high we hadn't seen in quite some time. So why the shift for the month of August? Well, the only thing that I can point to that has caused individual investors to become a little bit shy, a little bit nervous at this point, are treasury yields, basically U.S. bond rates. That is the only thing that has had a major shift. And we have a chart of the U.S. Treasury yield right now. It is basically the 10-year Treasury yield. We can put that up. And you can clearly see how the 10-year U.S. bond rate has moved significantly above 4%. In fact, this is the highest the 10-year government bond rate has been at really in about 22, 23 years. The last time we saw bond rates, the 10-year at this level, was back 2006, 2007. So you can clearly see here how much just in the last few months bonds have moved higher. And as we know, when bond yields move higher, those interest sensitive parts of the market don't like that. Banks have turned down because of it. Tech stocks even pulled back recently because of it. So really, it's been this bond yield, or the 10-year, and even the 2-year has gone towards 5% recently, that has started to spook investors. So here you have the 10-year. If we were to look at a couple of other charts, we can go to the S&P 500. You can actually see that the S&P 500 is total opposite. As bond yields have moved higher starting in August, the S&P 500, the biggest index for North American stocks, has moved down. You can see it start at a high at the beginning of August, and towards the right-hand side of that chart or that graph, you can see it starting to move down. The NASDAQ, which has been the winner, the all-star over the first 7 months of 2023. If we pull up a chart on the NASDAQ, you will see the same thing. As bond yields continue to rise well above 4% on the 10-year, the NASDAQ has sold off as well. So what does this all mean? Should investors be nervous? Should you be selling your investments? Well, I always say, I'm not about to sell my good quality companies just because bond yields are higher. Should I sell my shares of AMD, Microsoft, or Apple just because bond yields are higher? I don't think so. As long as fundamentals at these companies are strong, the fundamentals are strong, their businesses are strong, they're growing on the top line, the bottom line is growing. To me, that is most important. Yields are going to go up and they're going to go down. But overall, I believe that over time, the good quality companies will rise to the top. And I'm not concerned about higher yields, at least for now. Obviously, if yields start to get significantly higher, perhaps, well above 5%, then maybe we will have to have a different conversation. But in and around 4%, 4.5%, even if it starts to approach 5%, yes, we're on the high end of things, but by no means, in my opinion, would this be a message for us to panic, for investors to panic and sell their good quality names. So going forward, let's keep an eye on these U.S. treasuries, on these U.S. government bonds, and let's just keep an eye to make sure that if things do get much higher, then we may have to make some changes going forward. But until then, I believe you continue to hold your good quality investments and even add to them if things should pull back because of these higher yields. Now's the part of the show when I talk about what I believe is important for individual investors to consider before you make your investment decisions over the next couple of weeks. And as I said off the top of the show, here we have 3 topics that I think are important for markets. Federal Reserve head Jerome Powell will be giving his annual speech at Jackson Hole, Wyoming. It is something that a bit of a tradition, I guess. All of the central bankers around the world gather at Jackson Hole, which is in Wyoming, to hear about what's happening with respect to interest rates, inflation, and to hear from all the different central bankers and hear what everybody has to say. Obviously, the headline speaker will be Jerome Powell, head of the Federal Reserve, and he will give his speech on Friday. The second topic that I think is important for individual investors to consider are NVIDIA earnings. Now, normally I don't put a whole lot of stake in just one company's earnings, but because NVIDIA has been so crucial and so important to this market, the leader of artificial intelligence, the leader of the tech stocks, the big cap tech stocks, NVIDIA has now become, I think, the 5th largest company in the world right now, over $1 trillion market cap. And really, the market didn't take off until NVIDIA reported earnings last time and spoke about artificial intelligence. So I think when NVIDIA reports earnings tonight after the close, I think their earnings will be crucial in how the market behaves. We'll talk a bit more about that. And lastly, investing ideas that have pulled back. I think there have been a number of companies that you could take a look at today, which may have gotten a little ahead of themselves, perhaps a month or two ago, that have now pulled back, that maybe you can go back to them and maybe add some more money to. So let's talk about the first idea that we have that individual investors should consider or focus on. And that's the speech by the head of the Federal Reserve, Jerome Powell. He'll speak on Friday, I believe, I think late morning or afternoon. And I expect him to continue to be what we would say is hawkish. I expect him to say that inflation is still not where they want it to be, 2%, that headline inflation or core inflation is still stubbornly high. Headline inflation has come down, but has recently ticked up a little bit from 3% to 3.2% in the US. And so I think Jerome Powell will say that they're going to continue to be data dependent and may have to raise interest rates yet again. And we'll see how the market takes that, because I think that is the expectation from all of us. So if we get what we expect, I think you could see this market rally. However, if Jerome Powell says something along the lines of what he said last year when he gave his speech at Jackson Hole, which was an 8-minute speech, and said basically they need to do whatever it takes to attack inflation, to bring it down, market didn't like that. And we saw the market sell off at the end of August and into September. And then the markets didn't bounce back until sometime around third week, I think, of October of 2022. We have a chart here where I think it's a fantastic chart showing us when the Fed hikes key interest rates, what happens to the stock market. Don't believe we've seen this chart before. I think it's a new chart that we managed to find. And I think it's pretty telling. When you look at the far left-hand side and you look at when interest rates spiked here above 6%, what happened shortly thereafter is we had a recession. And then, of course, the Federal Reserve cut interest rates all the way down. And then interest rates picked back up in 2005. And then what did we have? Well, we had another recession and interest rates came right back down. And then interest rates remained pretty low for the foreseeable future. It started to come back up again. And then we had coronavirus or the pandemic hit us. And then what happened? We dropped interest rates again. So that was a little bit different because we didn't see a recession this time when we raised interest rates. Well, here we are again on the far right-hand side of this chart, this graph. We have interest rates now, or the Fed funds rate at 5.5%. I think a lot of investors are wondering, will we see now another recession? Will we see interest rates go higher than or approach 6% or go higher than 6%? And will that cause, I guess, the latest recessionary times? So that's really, I guess, the gist of why this market is so jittery and why when the Federal Reserve head Jerome Powell gives a speech like the one he's going to give in Jackson Hole, why everyone's going to be on edge. We're going to parse through everything that he says, cut it all up and analyze it so many different ways to see what is his thinking. Is his thinking they're going to raise rates again in the fall, maybe one more time and then done? Is he going to raise at all? Or perhaps he's on hold to see what happens heading into 2024. We have one more chart here on U.S. Consumer Price Index, which is your measure of inflation. And you can see how inflation continues to come down, although, as I mentioned, there's a little bit of a pickup on the far right. Inflation went from 3% in the U.S. to 3.2%. Core inflation, which when you take out food and energy, that's come down below 5% to 4.7%. And if you were to take a similar chart here in Canada, you would see that our inflation rate also went from 2.8 to actually 3.3, so slightly above the US rate. So even the inflation rate in our country has, I guess, poked a little bit higher. And what is our central bank going to do? Will the Bank of Canada considering raising interest rates in the fall? I don't believe central banks in Canada or the US will raise in September, but what will they do in, come the fall, October, November? Will they raise rates again? So the speech at Jackson Hole, my opinion, is something for individual investors to focus on. The second point that I wanted to touch on, as I mentioned earlier, are NVIDIA earnings. And as I said, NVIDIA has been the leader for this market. The market truly did not take off until NVIDIA, in their last quarterly earnings, said they're doing phenomenal. They took up their expectations by quite a bit. Probably the best earnings report that I've seen out of any company, perhaps ever, or at least for quite some time. And so, yes, coming into NVIDIA's earnings tonight, the bar has been set pretty high. Will they be able to beat a high bar, or will they just meet expectations? In my opinion, if they just meet expectations, they could see, or we could see, their stock price fall. And with it, many of the other tech names, some of the other chip makers, and some of the other tech names that are affiliated with, or when you see their name, you associate them with artificial intelligence. We have a chart on NVIDIA, which we will show, of course, and you could see how well NVIDIA has done. This is a pretty good chart, nice chart over the last 6 months or so, and you can see how NVIDIA has performed. And again, I always say that you can't just rely on one investment idea to give you an indication how the rest of the market is going to perform. Obviously, there are many other sectors that you can invest your money in, but I think a lot is riding on this performance. And we know that the S&P 500 is made up of a lot of tech names, and roughly 30% of the S&P is technology stocks. And we know NVIDIA has been the best performing tech stock and one of the biggest companies in the world today. So let's keep an eye on NVIDIA earnings after the bell. Let's see what they have to say. Let's see what CEO will say with respect to being able to provide all the chips that are necessary to power all this artificial intelligence from all these companies. We know right now what's restricting or preventing NVIDIA from earning even more has been the ability to produce. Obviously, they need to, try to keep up with the demand, and right now it's very difficult. And until other companies like AMD or perhaps other chip makers start to, produce or develop chips to power artificial intelligence and become more mainstream, like NVIDIA pretty much is the only game in town. So let's hear what they have to say, and let's see how it moves markets come Thursday. The last area that I wanted to touch on that I think individual investors should focus on before you make your investment decisions is this idea of buying investments that have pulled back recently. Some of the names that I've liked that we've talked about on this show, like Bank of America, for example. We have a chart on Bank of America. It was well above $30 a share recently and has recently pulled back into that $28 range. And I know we have US Bancorp there, but we can show Bank of America. I believe we have a chart on Bank of America. There it is. And you can see here it was $29, but I can tell you now it is below $29, trading at only 8 times earnings. So single-digit PE multiple for the second largest bank in the United States. I think a fantastic bank to own and something that you could see has pulled back. Another name that has pulled back by quite a bit is Meta Platforms, formerly Facebook. And again, a name that once upon a time, not too long ago, maybe just a few weeks ago, was trading at $325, $330 a share, now into the 280s. We've seen a 10 to 15% pullback on a bunch of names that I think are very good quality. Meta Platforms, or Meta, formerly Facebook, is one of those names. And last but not least, Microsoft. Microsoft, second largest company in the world, $2.5 trillion market cap, or maybe a little less now that the stock has pulled back. You can see here, $320 a share. Once upon a time, maybe 3 weeks ago, not that long ago, $360, $365 a share. So another name, another great quality name that I think individual investors perhaps can get excited about if you were to continue to see some of these names pull back in price. And again, nothing has changed with these companies. What I think is happening is market is getting just a little bit concerned because of higher yields, perhaps some seasonal factors starting to play in for the months of August and September. And I think those are the main reasons why we're seeing a number of these companies pull back, basically drop a little bit in value. And these names are such good quality that I would look at these as buying opportunities. So before you make your, I guess, investment decisions over the next couple of weeks, try to find some of these names that have perhaps dropped a little bit in share price due to factors that have nothing to do with the company's fundamentals, but still have a great outlook going forward, and names that you could be comfortable owning and comfortable sleeping at night, knowing that these are the best names and 5 to 10 years, but I'm not a believer in that idea. The China economy has struggled quite a bit, and I think you can trace their struggles all the way back to the pandemic. Coming out of the pandemic, when the rest of the world was starting to move forward again and reopen, China had a no or a zero COVID policy, which meant if there was even the slightest bit of COVID detected in the country, things would shut down again. So they remain closed for business for a lot longer than most other countries. And they really have never rebounded since. We've seen GDP or growth numbers over the last 6 months come in, not bad, but nowhere near what was predicted or expected. They have not recovered to where they were back in 2019 prior to the pandemic. And so China continues to struggle. Now, not only are they struggling with respect to exports, they're not importing as much, they're also struggling with respect to real estate. Some of their biggest real estate developers in China are struggling under the weight of higher debt. We've actually seen Evergrande, which is a company that is a property development company all over the world. They've actually declared bankruptcy most recently in the United States, and they're undergoing a restructuring plan in other areas of the globe. So China overall, they've always had, or they've always, their people have always been big investors into real estate, to their own real estate. And we're seeing that a lot of the properties, the developers, are starting to struggle and not make their debt payments, not make their interest payments. And so a big worry for China, and a big reason why many investors today have pulled their money out of China, out of real estate. I also think another big reason why China continues to struggle, and one that's really not spoken about, is the pressure that companies in other countries are putting on China. For example, the United States and the rhetoric, the back and forth between China and the US now stopping or not allowing certain exports to China in the tech sector. Certain chips are no longer able to be sent from US companies to technology companies in China. So there have been restrictions placed on US companies with respect to their dealings in China. The back and forth continues between China and the US, and so that is causing a number of companies to be scared. What if, because the US has restrictive measures on some of their exports to China, what if China retaliates and says, okay, these US companies can't do business in their country now? So what if there's some tit for tat, some retaliation? So a number of companies, in my opinion, have started to consider this. Perhaps considered moving some business, some production out of China. I know Apple is now a lot bigger in India than it was ever before, moving business from China to India. I know countries like Malaysia and Thailand have definitely gained a lot of business from other companies that are trying to expand with their numbers. We have a chart here on the Shanghai, which is their index, and you can see basically since the year started, their index has not done a whole lot. It hasn't really made anything, and they continue to struggle with growth, production. They actually are cutting interest rates when many parts of the world are actually raising interest rates. They're cutting interest rates in China to stimulate. They just reduced their one-year bond, which a lot of people's lines of credit and household borrowing is dependent on, although they didn't touch the 5-year bond, which a lot of mortgages are dependent on. So maybe down the road, we may see a cut in 5-year bond rates. But for now, China continues to struggle. And as I said, I think they continue to struggle because of a bunch of reasons. And overall, yes, this will affect global growth. It'll affect world growth. And when you have the second largest economy struggling, you can expect things to slow down. And, we've talked about on other shows how the price of oil is definitely affected by what's going on in China. So let's keep an eye on what's going on there. Whenever they report some economic data, let's see how it looks. Are things getting better? Are they still continuing to get worse? Or have they kind of settled in? So let's keep an eye on what's going on. And moving forward, I think there will continue to be an important part of world growth. And as I said off the top, I think it'll be a long time before they catch up to the United States, but definitely an important part for the global economy. U.S. banks have been under a lot of scrutiny this year, and really for one main reason, and that is what we call net interest margin. So what that simply is the spread between what banks pay out for their high interest savings accounts, their GICs, for example. There's certificates of deposit in the U.S. or CDs. So what they pay as interest versus what they charge as interest. So there's always a spread there, what they charge versus what they pay. And obviously, if they can charge more than what they're paying out, then they make more money, simply put. And we call that net interest margin. What we've been finding over the past year or so are the banks having to pay out more interest for some of the products that they offer, like high interest savings accounts, for example. If they don't pay out higher interest, then many investors will take their money out of the bank and stick it into a short-term government bond, which is, as we know, paying close to 5% or in and around 5%. So we've seen a lot of the major banks in the United States and even in Canada now have or seen their net interest or their spread shrink. And that has caused a lot of concern. It's caused a lot of concern with smaller banks and even some of the larger banks. And some of the ratings agencies recently have said that the banks or the banking sector is on watch. Even large banks will be on watch to perhaps see their credit rating drop from where they are currently. So we have a couple of charts here, a bunch of charts here. One is U.S. Bancorp, which is one of the largest regional banks in the United States. We call them a super regional. You can see the fall that they took in March when we had the bank failures, and we saw a nice pickup since then and recently pulled back because, again, these ratings agencies are starting to point out that these banks are in tough. They're in tough because interest rates are higher. And banks have actually become one of those interest-sensitive investment ideas that has fallen when interest rates go higher, which is a total switch to what we've been used to over the years. We used to say when interest rates go up, banks can charge more for the loans they provide and they make more money. Well, at this point in time, with regulators telling the banks that you can't lend as much, you need to keep more money on the books, because if we were to go into a recession, you need some money there. So they're not lending as much, therefore not generating as much revenue. They have to pay out more interest on the savings accounts that they provide, for example, so they're not making as much money there. And overall, as the economy slows, businesses aren't willing to take as much out in the way of loans, borrow money to grow their business. We're not seeing an IPO market, not as many companies going public or doing as many bond offerings or trading as much. So overall, the banks are having a difficult time. And this is U.S. Bancorp as we have, but we could show a couple of other banks as well. PNC Financial, another super regional bank, not as big as the big money center banks that we always talk about in the U.S. But again, this is probably the 7th largest bank in the U.S. And once again, a similar chart to U.S. Bancorp, bounced back after the sell-off in March, but has recently turned downward. We could even pull up some Canadian banks. TD Bank here, we have a chart of as well. And you can see that TD has moved back down towards its 52-week low in the low 80s right now. I believe it got as low as the high 70s, producing a dividend, nice dividend. If you're looking to make a good purchase today, perhaps TD is a good opportunity, 4.6%. And lastly, I believe, yes, we have one of Scotiabank, Bank of Nova Scotia. Bank of Nova Scotia, interesting enough, is back down to its 52-week low. Its yield on its dividend yield is getting close to 7% once again. So Scotiabank, a name, third largest bank in our country, perhaps an opportunity to make a buy. But make no mistake, banks are definitely under a lot of scrutiny, and the ratings agencies are on watch. They've said they're on notice. They'll be watching what the banks do and how they perform going forward. And of course, that will make all the difference as to how the bank sector and banks as an investment idea for your portfolio, it'll matter for that as well. If you were given some money today to invest, where would you invest? In my opinion, I think you have three choices today. Number one, you could go into a very short-term, low-risk investment and take that 5% yield or interest payment that those investments are paying you today. And we have a chart to show that. We can pull up the US 2-year Treasury. Some people will say, you know what, that same investment idea was paying 1-2% just a couple of years ago, and it's paying a lot more today. So I'm going to move some money into a US Treasury, play it safe, low risk, no problem. Canadian bonds, Canadian government bonds, are not paying as high as US, but they too are paying higher rates. You could buy a money market mutual fund, so low risk, paying close to or in and around 5% as well. So option today, play it safe, buy something that's going to pay you 5%. Second option that you could have would be going with or investing in some of the ideas that took this market higher for the first 7 months of the year. We call them the Magnificent Seven. And we can show our chart on NVIDIA again. They were part of the Magnificent Seven. And these are the big cap tech names. These are the biggest tech names in the world that powered the market, led by NVIDIA, higher and for the first 7 months. Microsoft, Apple, you could even throw in AMD, Google, Meta, Amazon. All these names, I think if you would have owned them or if you purchased them at the end of last year, you would have done quite well. So the question is, if you had money today to invest, do you go back to what has worked for the first 7 months of the year? Do you risk the fact that maybe a lot of the good times or the better times have gone by already, that maybe the best days for these stocks have already happened? So that's the risk of buying into a sector like the tech sector, but specifically some of these big tech names that have already had tremendous runs. Or third, perhaps you buy some value names, some names that haven't worked as yet, some of the names that haven't really gone significantly higher. And we have a bunch here. I call them value investments, but you can call them what you will. They are growth names. First one we have is Caterpillar. Now, Caterpillar is a little different because, as you can see, has gone significantly higher. A lot of people don't talk about Caterpillar, but it's had a fantastic run. Maybe you continue to buy Caterpillar with this idea of the United States continuing to spend money on infrastructure. Caterpillar has done extremely well in 2023. A name like Deere & Company, so the company that produces the tractors and the big machinery, primarily for the farming industry. We can see here after Deere reported earnings recently, stock fell quite a bit. Used to trade in that 430, 440 range, now down well below 400. So maybe this is a name you want to buy because really, if you look at it since the start of the year, it's up, but perhaps it has a lot more to run. Another name here on our list that I've put is Nike. Now, everybody knows Nike. We all, I'm sure, have owned a pair of Nike running shoes or some sort of sports equipment or jerseys or something over the years. Nike is interesting because it just went through, or in the midst of, I think it's had like 8 to 9 trading days in a row of negative. So they've been down 8 or 9 days in a row. And so you can see that Nike just trading above $100 a share. definitely has not participated in the rally. And I think a lot of that has to do with their business over in Asia, especially China. As China comes back and starts to do better, I think you'll see that reflected in the stock price for Nike, because China is a very big market for Nike. So maybe you want to go into a value investment like Nike. The next one I have here is Home Depot. Now, Home Depot is interesting because it too has had a pretty good run, although you could see on the far right hand side of this chart, kind of a bit of a double top there, and it has pulled back a little bit. Keep in mind, Home Depot used to be over a $400 stock a few years ago, so well off their previous all-time highs. But right now, just struggling under the weight of this notion that the economy is slowing, that people won't stop or at least slow down their spending, and they won't spend as much on their garden or on their home. I happen to disagree. I think Home Depot is a great idea, especially when people aren't turning over their homes, selling their homes, buying new homes as often at the present time due to higher interest rates. They're going to stay in their existing homes and perhaps freshen them up, do things to their existing homes, renovate, make things a little newer and better. And where else do you go to fix up your home? Home Depot. So I think Home Depot is a great idea and a value idea. So just to recap, if you have money today, where do you want to be? Well, you can go into short-term bonds paying 4.5%, 5%. You could go into high cap tech names. You can go into the Magnificent Seven, as I've called them in the past, the biggest tech names, the biggest companies in the world, the names that took us to 52-week highs in July. Or you may want to go more into things such as value names, those names that haven't gone up as much as yet, but yet you believe at some point will have a good future. I wanted to touch on retail earnings because I think it's very important for individual investors to consider, actually, because it gives us a good snapshot as to, are people spending? If people stop spending, then that becomes a problem. We know that the majority of GDP growth in the United States, and a lot of it here in Canada, is based on the consumer spending their hard-earned money on flat screen TVs, computers, sports equipment, you name it, buying cars, refrigerators, whatever it is. We need to keep an eye always on retail sales, what the average person is spending. And retail earnings are a good glimpse into that. And we had some of the biggest retailers in the United States, and I guess in the world even, report last week. We have a chart on some of them, and I wanted to just touch on them. First one, Walmart. I thought they reported fantastic earnings. Walmart, they get a pretty good rating because a lot of their business is in the food industry. And as we know, when times are tough, people still have to eat. So food is something that Walmart has, I guess, incorporated more and more into their business. And it has fared them well at this time when discretionary spending is now being called into question, meaning if you don't really need to buy that item of clothing or whatnot, maybe you just don't buy it. Well, at Walmart, at least they have their food business to fall back on. And so Walmart actually took up their expectations for the future, reported great top line and bottom line growth. And Walmart, I think, trading near its high. Tough to buy today just because I think it's not a cheap investment idea at this point in time. But maybe on some sort of pullback, we would take another look at Walmart. Another retailer I have is Target, a name that we all know is now, I guess, a U.S. retailer. Once upon a time, it was up here in Canada, but recently left Canada to just go back to the U.S. And Target, very different earnings results than Walmart. They actually took down their expectations going forward. They spoke about things such as discretionary spending slowing down. They spoke about, in the U.S., this idea that students will have to pay back their student loans. There was some talk over the last 6 months by the U.S. government that they may forgive student loans. Well, here we go. That didn't go through. And so individuals, parents, students will have to pay back those loans. They talked a bit about that. But overall, Target did not have the greatest earnings data last week, yet their stock actually went higher when they reported. Perhaps many investors thought, well, this was as bad as it gets, and this was some sort of floor or trough or bottom for the stock, and they started buying into Target, whereas Walmart shares actually went down after their earnings. So that was kind of interesting to see. Walmart had the good report, Target had a weak report, yet Target shares went higher and Walmart shares went down. So I guess you never know what individual investors will focus on. And so retail earnings to me is always something that I like to look at. We also heard from Home Depot. We don't have we actually showed the chart of Home Depot earlier, but Home Depot reported last week as well. And Home Depot was kind of somewhere in the middle. They didn't say as many good things as Walmart did, although they didn't say as many bad things as Target, and their earnings were better than Target. So they came somewhere in the middle, and their stock price went up slightly. So there you kind of have it, right? Walmart's at the on the good side of things, Home Depot in the middle, Target on the weaker side. Yet Target shares went up probably the most, followed by Home Depot, and Walmart actually went down. So you got to really study these retail reports, and investors will parse through them and take what they want out of it. And obviously that will move the shares of these stocks. But overall, retail spending continues to be strong, both in Canada and the US. And as long as people are working and have jobs, as we know, because we have full employment in the US and pretty close to full employment here in Canada, people will continue to spend and continue to drive this economy forward. Now we come to the part of the show where I like what I like the most, which is taking a couple of your questions. And we have a bunch again today, which is great to see. First one here: how do you measure success for your clients? Ooh, I like that question. So I don't think I've had that question before. How do you measure success for a client? Well, I think it's actually quite simple. If the client reaches their investment objectives. And I guess for some individual clients, you don't know the answer to that if they reach their investment goals until later on. It may take years before you know if the client has had success. You obviously could have targets, annual targets, maybe even quarterly targets, although I wouldn't suggest it. But let's say annual targets, 12-month targets along the way to see if you're meeting those targets. And obviously, if you are, then you are having success. So it really just depends on the individual investor, how they measure success and what they think success is. For some, it's growth. For some, it's a steady income. For some, it's capital preservation. So for everybody, it's different. But overall, I think, to measure success, it can be done in many different ways. But overall, it's a matter of what the client thinks. What is the person who's watching this show, what is your measure of success? And are you obtaining or are you reaching success with your individual investment advisor? Take another quick question here. How often should I be reviewing my investments with my investment advisor? Another good question. And again, depends on the investor. I have some investors that I talk to weekly. I have some investors that I talk to perhaps semi-annually. I get together with some face-to-face. We go for lunch and review the portfolio once a year. It just really depends on individual investors. I tell all my investors that I'm watching your portfolios on a regular basis. I would say if nothing comes up urgently in a portfolio, I'm probably looking at a portfolio every 6 to 8 weeks just to see if anything needs to be done with that portfolio. So I'm always looking, I'm always watching. And if something pops up, an investment drops or goes higher or needs to be sold or bought, etc., I'm always watching. So individual investors that are my clients, for example, will always have the benefit of me watching their investments versus I know a lot of investment advisors that maybe look at things once a year. So I'd like to tell my clients and my investors that I'm always on top of things. I'm always here to answer your questions with regards to your portfolio at any point in time. So to answer this question, again, it just depends on the investment advisor and the client that they're investing money for. So with that, we've come to the end of the show. I'd like to thank again everybody for tuning in today and let everybody know that we'll be back again 2 weeks from today at 12 noon, which is September the 6th. And until then, happy investing.